Hello folks, and welcome back to another crypto video, financial video. I am your host, who is a host, and I'm not a financial advisor, and we have two topics today that I will try my best to make interesting for you. I am obviously in a lack for energy. I'm at an all-time low that I have not experienced for a while, but I will try my best. I'll try my best. Normally I would do 4 topics, but I think you understand. Oh man, I can't get more than 2. Oh man, it's 5:11 already. I gotta get a nap and oh man. So anyways, today we have 2 topics today, April 10th, 2026. For those of you wondering, I mean, I don't think anyone's wondering, but yesterday I had for April 9th I had a video that I was gonna do, but the microphone was acting wonky, and so it was like by the time I realized the audio didn't record, it was like 8 at night, too late. I mean, there's nothing I could do, honestly. I should have just got up and recorded again, but you know, it is what it is. So anyways, today, April 10th, 2026. The 2 biggest topics really in finance is consist of a few things, right? Or well, actually consist of just 2 things. And one is the dominating the crypto landscape, or the intersection of macroeconomic pressures on Bitcoin, and then secondly, the massive structural shift toward institutional tokenization. So, number 1, Bitcoin's macro stress test. So Bitcoin is currently caught in a tug of war between geopolitical relief and economic anxiety. And so while a sudden ceasefire deal between Washington and Tehran initially sparked a relief rally to a 3-week high, the momentum is now facing a reality check from 2 major factors. So what? The inflation test. Fresh macro data specifically on oil shock and persistent inflation jitters, and is testing the durability of the current rebound. And then number 2, institutional fragility. So analysts are watching open interest closely, noting that while Morgan Stanley's spot Bitcoin ETF recently debuted on the NYSE, the current price structure suggests a squeeze and fade pattern rather than a definitive breakout. And then number 2 for the topics of the day, the great tokenization pivot. So we are seeing a move away from pure speculation toward real-world asset RWA tokenization and stablecoin utility. So this isn't just a trend, it has become a structural shift in how capital moves, and so this is mainstream licensing that's going on, and major players like HSBC and Anchor Point Financial just secured the first stablecoin issuer licenses in Hong Kong, signaling that the internet's dollar is now a regulated reality, right? And so there's also integration in traditional finance, as companies like Securitize are integrating with major blockchains like Tron to bring tokenized treasuries and equities to production scales. Now I hope my thing was recording. Oh, that'd be horrible if it wasn't. Microphone wise, I can't do another one not going. Oh man. So anyways, and also AI agents. So there's a surge of in intelligent commerce, where AI agents are now being used to manage portfolios and execute payments autonomously using crypto rails, moving these tools from pilot programs to mainstream financial workflows. So we're gonna get into our first topic. So the recent volatility in Bitcoin isn't just a crypto thing; it's currently acting as a high sensitivity gauge for global geopolitics and energy markets. And so a deeper look at the 3 main forces driving the macro stress test is 1, the oil for Bitcoin trade. So Bitcoin's recent rally to $73,000, $310, which is higher than yesterday, as of this afternoon, was triggered by a specific geopolitical event. As you should all know, the 2-week U.S.-Iran ceasefire, which is being used for negotiations. And so the chain reaction. Hold on, let me get some of my water. I don't know what I was gonna say, but guys, gotta stay hydrated. You know what I realized? Or no, what I learned recently, I think, or like I learned about hydrates, right? What hydrates are, right? And so like when you're the reason they call it hydrated is because the water it goes into you, and it bonds to like other things or something like that, right? And when water like bonds with like different like compounds, the compounds become hydrates, and that's why when you drink water, it's called being hydrated. And then when the water leaves and like you don't have much water, it's being called dehydrated. And then it's like anhydrates or whatever. So, anyways, what was I right? So when the ceasefire was announced, crude oil prices collapsed from a peak of $112 per barrel, right? And the inflation pivot, so lower oil prices immediately cooled inflation expectations. And this shifted the market's bet on the Federal Reserve interest rate cuts from zero chance to possible in late 2026. And the result is that the risk-on sentiment poured into Bitcoin, causing a massive $427 million short squeeze as traders betting against BTC were forced to liquidate their positions. So, number 2, the Morgan Stanley flywheel. So, a major reason Bitcoin is holding its ground despite the macro noise is the successful launch of the Morgan Stanley Bitcoin Trust MSBT this week, which I mentioned in a previous video. Unless it was yesterday's video, I think I covered it in one of my previous videos. I mentioned my yesterday's video, but I didn't get to post that because I said it went off, so yeah. So there's an institutional adoption. It is the first spot Bitcoin ETF from a major U.S. bank in its 48 hours, and it saw roughly $34 million in inflows. So people are looking at very, as most analysts would say, very bullishly. They're very excited about this. Different investors are liking it, and so people are capitalizing. And then number 2, there's a spinning flywheel. So analysts suggest that this is just the beginning of a flywheel effect. And as Morgan Stanley's massive network of financial advisors begins moving even a tiny fraction of their client portfolios in OSBT, it creates a consistent buy wheel that hasn't existed in previous cycles. And then number 3, the oil cliff and liquidity crisis. So despite the current rally, there's a looming deadline that has many analysts worried, and that would be about a crash back toward $55,000 or lower. And so there's like this mid-April deadline. So global emergency oil reserves, which I believe were released in March to stabilize the market, are expected to hit an oil cliff around mid-April. And there's this liquidity trap. So if oil prices spike again, once reserves are exhausted, inflation fears will return. Because Bitcoin has shown an 85% correlation with the NASDAQ 100 recently. And any macro-driven sell-off in tech stocks will likely drag Bitcoin down with it. And so, like, a current technical outlook of this is Bitcoin is testing the $73,500 resistance level. If it breaks and holds above this, the path to $80,000 is open. But if the ceasefire fails or oil prices rebound next week, the market is bracing for a potential drop to $62,000 to $66,000 support zone. Okay, so that basically wraps up for our topic 1. We're going to topic 2. And so the second major trend is institutional tokenization. So it's currently undergoing its broadband moment, right? So if the early 2020s were just like analogously, right? Just to make an analogy, if the 2020s were the experimental dial-up phase of moving assets onto a blockchain, then 2026 is essentially when the infrastructure has finally become fast, regulated, and industrial scale, right? And so here's a breakdown of this structural backbone, so to speak, of the current market. So 1, there's the Hong Kong stablecoin greenlight. So just of today, April 10, 2026, the Hong Kong Monetary Authority, HKMA, officially granted the first stablecoin issuer licenses to HSBC and Anchor Point Financial, which is a powerhouse joint venture involving Standard Chartered and Animoca brands, right? So why it matters? This isn't just another crypto exchange getting a permit. It is one of the world's largest banks, HSBC, now authorized to issue its own regulated digital currency, right? And so the impact of this is that it moves stablecoins from shady offshore tokens to sovereign-grade digital cash and allows institutions to settle billion-dollar trades instantly on-chain without leaving the regulated banking system. And then number 2, the real-world assets RWA top $15 billion. So the tokenization of everything is no longer a theory, as you should know. As of this month, tokenized U.S. treasuries have surpassed $11 billion on in-chain value, or in on-chain value, right? And so, like, BlackRock's Build a Lead, which I had spoken about, but the video didn't come out. So the BlackRock USD Institutional Digital Liquidity Fund, BUIDL, remains the dominant player, holding nearly $3 billion in assets, and is also the yield hunt. So investors are no longer buying Bitcoin for number go up. They are holding tokenized gold, stocks, and money market funds, MMFs, on chain because they can earn 4 to 5% yield while keeping their capital liquid and 24/7 tradable, right? The number 3, there's there's an agentic commerce, which is where AI meets crypto. So a massive subtopic this week is the rise of AI agents using crypto as their native currency, right? And the concept is that autonomous AI agents are being deployed to manage corporate treasuries and execute complex, if-then, financial strategies, right? And so there's this killer app, because an AI cannot open a traditional bank account or sign a physical contract, and so they are using Ethereum and stablecoins to pay for cloud computing, verify data, and settle transactions. And industry leaders are calling this the killer app that will finally move crypto from speculative asset to a functional utility. And the big picture really is the convergence, as the narrative shifted from crypto versus Wall Street to crypto as Wall Street's new OS. And with the SEC pivoting from enforcement to integration earlier this year, the focus for the rest of 2026 is on atomic settlement. And so the ability to trade a stock and have the cash in your account in seconds, not days, right? That's atomic settlement. And so a summary of this shift is that, we have 3 features. There's a primary driver, regulation, and main use case. So there's the 2021 era. So retail was hype and meme coins. The regulation was really the Wild West. And the main use case was just trading and speculation, right? But now it's become institutional RWA/yield. The regulation is licensed like HSBC and Buildo, and the main use case is payments and AI automation. And so what could all this mean? Well, when you put the two trends together, we aren't really looking at a price rally, right? We're seeing the industrialization of crypto and the convergence of Bitcoin as a macro hedge, and the rise of tokenized assets, which suggests 3 major shifts in how the world handles money by the end of 2026. So the one shift is the death of crypto winters. And historically, crypto was famous for 80% crashes, but with the Morgan Stanley ETF debut and the influx of pension and sovereign wealth funds, that retail panic cycle is breaking. And so the logic is that institutional capital moves slowly and programmatically, and this creates a structural floor for Bitcoin, which is currently oscillating between $60,000 and $75,000, right? And so the result is that we are moving toward a lower volatility and higher value regime, and Bitcoin is becoming more like digital gold or a tech stock than a speculative gamble. And then the second pillar is that there's the rise of machine GDP, right? And so the expansion of AI agents using crypto rails is arguably the biggest fundamental shift in a way, right? Because there's an autonomous economy. By the end of this year, we're likely to see the first measurable agentic GDP, which is economic value created entirely by AI to AI transactions. And then why crypto? An AI can't walk into a bank, but it can hold it like a private key, right? And as these agents pay each other for data, compute power, and API access using stablecoins, they create a massive 24/7 economy that exists entirely outside of traditional banking hours or even the traditional market itself, really. Albeit using it, they're like kind of outside in what people are actually doing, right? And so there's also, number 3, this is another pillar, there's this invisible blockchain. So perhaps most importantly, which is number 2, tokenization, meets blockchain, is becoming infrastructure and not a destination. So it's like there's seamless finance. So when you buy a tokenized treasury bill through a bank like HSBC, you might not even know it's on a blockchain. You just see instant settlement and a 5% yield, right? And the takeaway is that the crypto part of the technology is moving to the background. In the way you don't think about TCP/IP, when you send an email, you most likely won't think about blockchains when you move money. And it will just be like a standard operating system for global finance. And so a little more on that is like there's like institutional price flow, right? And Morgan Stanley and fees. So the launch of Morgan Stanley Bitcoin Trust (MSBT) today on the NYSE Arca isn't just another ETF. It's a declaration of a price war. Now I mentioned this in a previous video, unless it was yes, it was previous video, right? And so there's this fee war going on with this, right? Because they launched with a 0.14% expense ratio, and that has undercut BlackRock, which is the current leader, who's at 0.25%, right? And Grayscale. And this race to the bottom in fees makes Bitcoin exposure cheaper for the average person than almost any other high growth asset class, right? And the bank affiliate era, this is the first time a major U.S. bank affiliate manager has launched its own proprietary crypto product. And it effectively onboards the most conservative capital in the world, which is high net worth individuals who only trust heritage bank brands, right? And then number 2, there's the stablecoin safe haven in Hong Kong. So the HKMA's decision to award stablecoin licenses to HSBC and Standards Chartered by Anchor Point is a masterpiece in regulatory strategy. And so there's programmable banknotes. These two banks are already authorized to print physical HKD banknotes, and now they're authorized to print digital ones, right? And there's going to be mass adoption, as HSBC plans to integrate its HKD stablecoin directly into its PayMe apps, which is used by 3.3 million users by the end of the year. And this means millions of people will be using blockchain-based digital currency for daily coffee or rent without ever needing to visit a crypto exchange. And then number 3, there's the DAI, decentralized AI search. So while Bitcoin fluctuates, the DAI sector, artificial intelligence on a blockchain, is becoming the dominant growth engine of 2096. And so, there's the as an example, the Bit&Start breakthrough. So earlier this year, Bit&Start TAO network completed the largest language model LLM training run ever recorded on decentralized network. And this proved that peer-to-peer networks can actually compete with the centralized giants like OpenAI or Google, right? And then there's also agentic commerce, and we are seeing the rise of agentic wallets, which are crypto accounts owned and operated by AI bots, like those in ASI Alliance, and that can autonomously pay for cloud computing or settle cross-border trades. And this is creating a new machine economy that operates 24/7, independent of human intervention. And then there's RWA, the anti-volatility hedge, right? So, really interestingly, while Bitcoin and Ethereum saw a dip in quarter one due to geopolitical tensions, the RWA market hit a record of $27.6 billion this month. And tokenized treasuries, over 12.7 billion of that, is being held in tokenized U.S. treasuries. And the logic is investors are using tokenized government bonds as a safe haven instead of moving to cash, which earns nothing on a crypto exchange. And they are moving into tokenized bonds that earn a 5% yield while remaining on-chain and ready to be deployed the second a market opportunity arises. And what it means really is really all just convergence. Bitcoin is your macroeconomic shield against inflation geopolitical risk. Stablecoins for banks like HSBC are becoming like the daily payment rail. Tokenized assets, which are RWAs, are becoming the primary way to earn yield, and AI agents are becoming the power users that drive the network's volume. And this is essentially what concludes us for the day. That's my information that I have to give you. I'm gonna tell you the sources where it comes from. Just hold on. Let me get this. Let me get the sources. The web sources. Let me get those real quick. And then we're gonna be golden. We're gonna be golden, boys. We're gonna be golden, right? So, we got the primary sources. There's the Bitcoin Magazine, NYSE archive filings, right? We have the Hong Kong Monetary Authority, HKMA, and MEXC News. We have CNBC Crypto World, Labor Department reports. We have FiNews.com, and then we have Nunchuck repositories, and that's the key sources of today's information. I hope you did enjoy. I hope this information was good for you. Remember, I'm not a financial advisor. This information is what you do with it. Stay smart. I just heard a weird sound. Stay smart, and I will hopefully catch you in the next one.